Hey everyone, it's Amit. So in this video, what I wanted to talk about is a couple of things. One, why do I believe that the stock market is overvalued? And two, why I believe that we are headed for a correction in 2021. So before we get too far into it, this is a personal finance channel focused on helping you make smarter financial choices. So without further ado, let's get cracking. So I'll break this video out into really three pieces, right? So I'll talk about some of the data in terms of why I believe the stock market is overvalued. Then we'll talk about some of the reasons why, which I've covered off in other videos as well. So I'm just going to briefly touch on this. And then the third thing I'll break it out in terms of is what am I doing personally with my own money. So definitely stick around for that as well. So the first thing is let's talk about the data. There's an indicator called the Buffett indicator. So what the Buffett indicator basically does is it pits your market capitalization of companies relative to real GDP. So market capitalization, the easiest way to think about it is it's basically a measure of how the stock market is doing. And real GDP is basically a measure of how the economy is doing. And I know there's plenty of other YouTube videos as well as articles on the internet and all the stuff that talks about, oh, well, is the stock market representative of the economy? And it does not seem to be the case. But what I'm here to basically say is, yes, that is not the case in the short term, but over the long term, you would expect those numbers to be aligned, because what you would expect is when you have the economy doing well, companies are going to do well. When companies are going to do well, the stock prices are going to do well. And you would expect that notion to be true, not just for a handful of companies, as what we're experiencing in the current case. What you would expect that to be the case is for most companies in the S&P 500 at least. So when it comes to this Buffett indicator, if you will, right, the basic notion is that this number, right, should be somewhere in the 100, 120 type of range, right, in terms of what the disparity should be between stock prices relative to the economy. You know, there's various articles that you'll see out there which even puts the number that you would expect this number to be somewhere between 75 and 100, and that's probably a fair estimate as well, but I've put it a bit higher, largely because I think over time the tech sector has done a lot better than other sectors, right, and there has been more of a disparity in this ratio because of that, and it becomes a bit of the new normal, if you will, right? So I think that's the reason why I would put this number at over 100 being normal, slightly over 100 being normal. Where we are right now as it comes to this ratio is we're sitting at about 187. To give you some level of context, even in other boom periods such as 2000, 2007, before we went into crashes immediately thereafter, this number has never been this high. So that's something that we need to be cognizant of, right? Which would basically drive, basically add some fuel to the notion that, hey, we are experiencing some level of overvaluation here. The second reason why I think the market is overvalued is the price to earnings ratio. Okay, price to earnings ratio, what that basically says is what is the price of a company relative to its actual earnings. You would typically expect this number based on historical context for it to be somewhere in that 15 to 20 range. We're currently at 37 times on price to earnings multiple. That means relative to your earnings, your stock is trading at 37 times that price. Okay, and I know there's going to be an argument out there that says that, oh, well, we had those other boom periods in 2008 and so on and so forth, right, prior to the housing crash, where price to earnings was well into the 40s, right? And I just want to say, right, that even though it was higher then, right, it does not mean that the stock market is not overvalued now, right? It was overvalued then, it's overvalued now, and based on our prior experiences, we know that it's resulted in crashes in the past. The third reason why I think the stock market is essentially overvalued is just growth, right? So the S&P 500 has had a growth rate of about 75% in the last 5 years. When you take the S&P 500 and you compare it to other indexes across the globe, right? So when you compare it to the France's CAC 40 or the UK FTSE index or even the Japanese Nikkei, the S&P 500 growth is significantly higher than any of those indexes. Nikkei has experienced 11% growth over the same period. The FTSE as well as CAC 40 are somewhere in the 2% range. Okay, so there's a significant disparity between the two. Now, the question may be that, well, the S&P 500 is more indicative of the U.S. economy, and the U.S. economy is doing a lot better than some of the other countries or economies across the globe. And the answer to that is it's simply not true. The U.S. economy has been growing somewhere in the 3% range over the same time period, right? And the world economy has been growing at over 5%. Okay, so that's the third reason why I think the stock market is overvalued. The S&P 500 is being driven by, really 5 or 6 stocks, right? Your FANG stocks plus Microsoft. So Facebook, Amazon, Apple, Netflix, Google, and and Microsoft. These companies are comprising over 25% of the S&P 500, and when you have that level of allocation to just a small basket of stocks, it's pulling the whole S&P 500 up. And when you have some of that kind of thing happening, right, it's definitely going to result in some level of overvaluation, primarily because the rest of the stocks are pretty much flat, right? So if they're pretty much flat, how do you experience the significant growth rate relative to the overarching economy? It just leaves more to question, right, in terms of why the stock market is actually so overvalued. Now, there's many reasons in terms of why this data points are showing so high and why we're entering into this overvalued range. And I'm not going to spend too much time on it because I've covered this off in other videos, but I'll just briefly touch on a couple of things. So the first reason why the stock market is going up is just this whole Robinhood and this retail investors, right? So Robinhood and other trading platforms have made access to the market more available to most, and that is absolutely tremendous. But what it's also done is basically allowed for people to trade options and to trade on margin, which are all very risky. It's like basically like giving a baby a loaded gun. Okay, so previously these options and margin accounts and all this trading was meant for sophisticated investors. Okay, it was meant for institutions. It was meant for people with a significant amount of capitalization, such that in the event that there was a loss, because these options and margins and all, they amplify losses. Okay, so they were meant for people who had significant net worth, right? And when you had significant net worth, you could absorb some of the losses without getting into too much risk. There's a ratio called the put-call ratio. Okay, so put-call ratio is basically comparing selling stocks to buying stocks in the future, right? So you're basically guessing what the price is going to be in the future and making investments based on that. And that's why it's a type of a derivative instrument or an option. Things like Robinhood have made this so easy to access that the put-call ratio is at the lowest level it's ever been. All that really means is all people want to do is buy. Nobody wants to sell anything, and that's what's driving an increase in the stock price. Other reasons why what is driving an increase in the stock price is the Fed coming out and saying we will not do any changes to interest rates over the next several years. So you're not getting anything by keeping your money in a bank account, right? You're not getting anything for putting your money in a certificate of deposit. You're not getting anything, so what's the default position? Well, I'm just going to take all my money and put it into the stock market. And that's what's happening right now, right? And that's what's driving or fueling the stock market increase as well. Another reason why the stock market is going up is the optimism around the vaccine, right? People are expecting that in the future, the economy to catch up to where some of these tech companies are, right? Your transportation, your hospitality, entertainment, all of those sectors to come along as well, right? That thought process is also driving some level of optimism and is fueling this overvaluation in the stock market as well. So you've got Biden presidency, right? And his notion of being a little bit softer on tariffs, and that's driving more optimism in the market. So there's a lot of these things, right? So it's just making the market more and more overvalued, if you will, than anything else. And that's why it's a reason to be concerned, or to have at least push the pause button and just to think about what is your investment thesis going to be. So I'll talk briefly about what is it that I'm doing. Okay, so over the long term, right? So when it comes to my retirement portfolio as an example, right, I'm doing absolutely nothing. Okay, I'm continuing to invest whatever I invest right now into the market every month, right? Because my fundamental notion is that this is some short-term noise here, right? And eventually we'll get out of all of this, and then the market and the economy and everything is going to align, and it's going to be a nice little package. Real GDP will continue to grow, and the stock performance will continue to be the same over the next, 10, 20, 30 years. So I'm not worried about it at all from a retirement perspective. When it comes to my short-term investments, what I am doing is I am building a cash position. So I am building a cash position such that when the market does tank, I will have the opportunity to enter the market at some pretty good valuation, and I'll be able to buy a significant amount of individual stocks or ETFs or whatever, such that I can realize some growth on it. To being opportunistic when other people are not. So that's what I'm doing, at least from a short-term perspective. So I'm very curious to know what is it that you're doing, right? So definitely include those in the comments below, as well as include comments in terms of what is your own personal notion about the stock market and where it's sitting from a valuation perspective at this point in time. So I hope you enjoyed the contents of this video. Definitely subscribe to the channel if you did, and hit the like button, as it'll help me out with the YouTube algorithm. And thank you for watching the video. I will see you soon.